Good morning, everyone. I hope you are well. My name is Karabon Kau. I am a tax honor student from the University of Pretoria, and I am with my colleagues Keneile Ndlovu and Anna Marie Vermaak. Today, we will be teaching you about an interesting topic called individual tax. Now, our table of content consists of the following: who is an individual? Why is it important to pay taxes? Residency, general information, and conclusion. Who is an individual? An individual is a natural person like me and you, whether they are non-resident or resident. It also includes sole traders and members of a partnership. Now, why is it important to pay taxes? It helps in building the nation in terms of the infrastructure. It helps fund welfare schemes such as grants, and it improves healthcare and quality of education. I will now hand over to my colleague.
Hello, I'm Anna Marie Vermaak and I will be explaining a few concepts of individuals' taxation. Firstly, I'll distinguish between a resident and a non-resident. So a resident is any natural person who is ordinarily a resident in South Africa or who is physically present in South Africa for a period greater than 5 years. So residents are taxed on their worldwide income. Then a non-resident is a natural person who does not meet the requirements of a resident. Non-residents are only taxed on their income that is generated within South Africa. The year of assessment for an individual refers to the specific year for which your income tax is calculated. This runs from the 1st of March to the 28th or 29th of February. We have a few types of taxes. The first being income tax, which is charged on both residents and non-residents on their taxable income. Then we have dividends tax, which is a tax charged on any dividends received in terms of a share held in any company. Then we have donations tax, which is charged on any resident whose total donations for the year exceeds 100,000 Rand. Then we have estate duty, which is a tax charged on the estate of a deceased person. Then we have value-added tax or VAT, which is a tax charged on the consumption of goods or services within South Africa. A tax threshold is the amount that a person's taxable income must exceed before they are liable for income tax. So if you are under 65 years old, you'll only be liable for income tax if you are earning more than 87,300 Rand per year, and if you are between 65 and 75, if you earn more than 135,150 Rand per year, and if you are older than 75 years, if you're earning more than 151,100 Rand per year. If you are liable for income tax, you will be able to claim a tax rebate, which is deducted from your normal tax. So if you are under 65 years old, you'll be able to claim a rebate of 15,714 Rand, and if you are between 65 and 75 years old, you can claim a rebate of 24,327 Rand, and if you are older than 75, you will be able to claim a rebate of 27,198 Rand. Now I'll hand over to my colleague who will explain the basic framework.
Good day. I will walk us through the basic framework. I'll start off by defining a couple of definitions. The first one being gross income, and it can be defined as the total income received for the year, excluding capital amounts. Capital amounts, among other things, include once-off amounts, such as the money that you receive from selling a capital asset like machinery in your business. Exemptions can be defined as the amount that is excluded from your taxable income by law. Pay as you earn or payee is the amount of tax payable on your salary that is withheld by your employer. It is treated as an advance payment of tax due and is deductible from your normal tax. Medical credits. So this is for everyone who is part of a formal medical aid. So basically what happens is that all the contributions or a portion of the contributions that you make towards the medical aid can be deducted from your normal tax. Now I'll be walking us through a calculation of normal tax using the basic framework and the definitions that I have explained in the previous slide. So I'll start off with gross income. This will include amounts like salary and rent income. This is if you're letting out property or rooms. And then we are going to list exemptions. This is from any interest that you'll receive, like from a bank, like Nedbank or Standard Bank or all those banks that are available, and any payouts from your pension. And then you will have an amount that is called income. From that amount, you will list deductions, such as rent expense. Rent expense only relates to the rent for where your business is operating, not for where a person will be staying. And the pension fund contribution. And then you will have something called taxable income. And then from there, you will use that amount to be able to calculate tax as per sliding scale. And I will explain further in the next slide. And then you are going to less tax rebates and medical credits, and then less payee or any provisional tax, and then you'll get your normal tax. I'll be discussing the tax table as per sliding scale. Like I had indicated in the previous slide, your taxable income is very important for you to be able to determine the tax rate as per sliding scale. So you're going to look at the applicable bracket in which your taxable incomes fall in, and then you will look at the tax rate that relates to it. For example, if you earn between 0 and 216,200, the tax rate that is applicable is 18% of every R1. In conclusion, small, medium, and micro businesses play a huge role in the economy because, among other things, they provide goods, services, they create jobs, and develop communities. This is not only limited to SMMEs from South Africa, but also from foreign nationals. So it is extremely important that people are enlightened about taxes and their responsibility towards the country, as tax is a strong pillar of the state and the society. For more information, please contact SARS by using the phone number and the email that I've provided on the slide and also in the pamphlet. Thank you for listening to our presentation.